Well, Treasury yields are a little lower this morning. That follows the jump that we saw after the U.S. credit downgrade from Moody's. Joining us right now on bonds, the Fed, and much more is Krishna Guha. He's the vice chairman of Evercore ISI and head of the global policy and central bank strategy team there. And Krishna, the reactions to Moody's downgrade have kind of been all over the map. Some people saying, uh-oh, this is a real sign of trouble. Others saying, don't worry about it, it doesn't matter, including Scott Bessent, the Treasury Secretary. Where do you come down on that spectrum?
Well, I think there's really no new information in the Moody's downgrade itself. The facts are all before us in terms of the U.S. deficit and the tax legislation and so forth. So I don't think the Moody's decision itself is a massive game changer. Some minor technical implications that can probably be ironed out for asset managers in some parts of the world. But the question is, does it serve as a coordinating device for concerns about the direction of U.S. deficits, the fact that the tax legislation really doesn't involve any serious fiscal consolidation, that we're looking at 6.5–7% structural deficits forever, except with a rising trend actually over time as entitlement spending steps up. And how does that interact with potentially reduced global appetite from Treasuries coming out of the trade wars and some of the other Trump administration decisions that are drawing back from some of the U.S. international engagements?
And what's the answer on that? We talked a little bit about that yesterday with Rick Santelli and some others. The idea that the nature of the buyer of Treasuries has changed a little bit over the last year or so. What are you watching, and what are any potential warning signs that you'd be on the lookout for?
Well, I do have an underlying prior here that pushing through a fiscal plan that has no consolidation in it, and at a time when I do think the global demand for Treasuries has moderated some, is likely to impart an upward bias to Treasuries yields, along with a sustained structural trend for dollar depreciation. Now, the issue with the Treasury yield itself is it's hard to power through 4.5% at a time when the economic outlook is still weak and uncertain. So I think what's happening here is that when the yields get pushed up, for instance, yesterday morning, it brings in domestic real money buyers, given the economic outlook. But at such a point where the economic outlook stabilizes, where we got some more visibility, I do worry that we could see yields push on towards 5%.
Let me try and translate that into something that dummies like me understand. I think what you're saying is if Congress pushes ahead with this tax bill and doesn't take any more fiscal responsibility with it, if they don't make some of the cuts to Medicare immediately or Medicaid immediately, if they do continue to offer more tax giveaways that would lower the revenue, whether that be taxes for tips or all of the other additional things that would be added in on top of the 2017 cuts, you think that buyers are less likely to show up for Treasuries?
Absolutely. You put it much better than I did. The point is here that I do think there's some reduction in global demand. What that means is that domestic buyers are going to have to buy the extra debt that's being issued here with this large, uncontrolled structural deficit. Think that means the yields likely do have to rise over time. The issue is just that they may not be able to power a lot higher right now because the economic outlook is weak and uncertain. But as soon as we get more visibility on that, provided it's visibility in a good direction, the economy is going to be okay, that's when I think there's this real risk that we pay the price in terms of rising yields, which would be also, of course, a headwind for the equity market.
Yeah, I don't know if you heard the comments we just made in the last block from Jamie Dimon talking about market complacency. He also said yesterday, specifically on credit, and I don't know if we have the full screen for this, he said, personally, I am not a buyer of credit today. I think credit today is a bad risk. I think that people who haven't been through major downturns are missing the point about what can happen in credit. I don't think he was talking necessarily about U.S. credit, but probably about corporate debt writ large. What are your thoughts about the potential for a downturn, and whether or not the market is being complacent here?
Well, look, I think the probability of a recession this year has come down substantially from close to 50-50 a few weeks back at the peak of all the tariff turmoil. But it's still significantly higher than normal. You know, is it 30%? Is it a bit less? But that's still a substantial recession risk alongside a baseline where, you know, the U.S. economy will slow to maybe 1.5% growth this year. So, you know, there is still significantly higher than normal recession risk. It's not clear that that's fully reflected in, for instance, the credit spreads that you cite.
All right. Krishna, if there's one point you watch next, I mean, we never know when something's going to crack in the markets. Things look pretty good right now. Would your bias be to the upside or the downside of what you think comes next?
So I am a bit wary in equity space after the very impressive bounce back that we've had. For me, the tell here is that the dollar refuses to rally on any sustained basis, and I think that's telling us something about a shift in global investor preferences. So watch the dollar. Can the dollar catch any renewed sustained bid? I suspect not. And keep an eye on Treasury yields. As I said, I think it's hard right now to break out above 4.5% because the economic outlook is weak and uncertain. And that provides a little bit of cover for equities. But watch out, if you see the Treasury yield being able to move up and hold higher levels above 4.5%, that would be a sign to me that concern over the fiscal deficit in a context of reduced foreign buying is starting to overcome concern about economic weakness, and that would create an additional headwind for stocks that we'd have to be very focused on.